Hello, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our webcast today on the overview of the exposure draft proposing the amendments to IFRS 17. I'm joined today by Sue Lloyd, Vice Chair of the International Accounting Standard Board. The agenda for the meeting today will be focused on presenting the views of Sue Lloyd, which are personal views, not the views of the Foundation or the Board, and my own views. In doing that, we have decided to carry out a bit of a double act where Sue is going to present the content of the document, and then I'll give some observation from a practical perspective. Having said that, I'd like to hand over to Sue to take over from here.
Thank you very much. So before we get into the details of each of the amendments that are proposed in the exposure draft, I thought maybe it's helpful to give a little bit of background about why the board is proposing to make targeted amendments to such a new standard. And basically, when we published IFRS 17, we always said that we'd monitor the implementation progress of the standard, and if it was necessary, we'd step in to help out with implementation by considering any need to make amendments to the standard. So really the main objective of the proposed amendments is to continue to provide support for the implementation of IFRS 17 by reducing implementation costs, and in some cases by making it easier for companies to explain their performance when they apply IFRS 17. So although the changes are narrow in scope, the proposed targeted amendments address many of the concerns and challenges that people have raised with us since the standard was issued 2 years ago. And we think that it provides meaningful support to companies when they're implementing the new standard. But importantly, the proposals don't change any of the fundamental principles of the standard. And this was one of the criteria that the board used when we decided whether to consider each of the possible amendments. We don't want to make big changes to the standard, as it would be too disruptive to implementation. And we know that there are some companies that are very well advanced in their implementation. And also, we wanted to ensure that the information provided to investors isn't reduced in terms of the quality. So this means that we considered but decided not to propose quite a few different amendments to IFRS 17. And as a result of this, we considered concerns and challenges expressed by stakeholders on 25 different topics, but we're not proposing amendments to address all of these different issues. Now, on this slide, we've set out some of the reasons for why we didn't consider some of the amendments. And it was really to do with things that were too fundamentally changing the standard, where there'd be too significant loss of information, or where we thought it would unduly disrupt implementation. And we've given some examples to try and explain our thinking. So if I look at a couple of those, the main reasons why we didn't propose to change the requirements around the level of aggregation was that we thought it would be too disruptive to implementation at this time to introduce a change to the level of aggregation. And also we thought that that would significantly reduce the value of the information that would be provided to investors. Also, some investors have been concerned about the amount of choice in the standard. Some would like us to remove the choice to present the insurance finance income or expenses in other comprehensive income rather than profit or loss. But we decided that at this stage it would be too disruptive to implementation to make such a big change to the standard. So we didn't make some of those changes, but what we did do in the basis for conclusions was set out the reasons why we didn't change those things.
Now, these areas probably are going to be a very interesting area for the stakeholders to reflect upon, because there are no specific questions being asked in this exposure draft, but obviously people will be wondering about it. So I thought that I would highlight a couple of practical implications that will follow from the decision to continue with the standard as it is. On the reinsurance contract boundary, the key point here is that obviously the IASB has maintained this concept intact. It's a cardinal concept in our opinion for IFRS 17. But what it does now, it creates some interesting practical implications on the calculations that insurance companies will have to do, both in terms of buyers of reinsurance contracts and if you are the vendor of the same, you will have to face this impact that comes from the necessity to estimate cash flows from contracts which have not yet been ceded from the cedent to the insurance company. And that means also that when you do the unlocking of the total CSM of our insurance contract, you may have to effectively discount the unlocking adjustment at the locked-in rate, whilst the cash flows from these future businesses, future contracts, will be reflecting a current measure of time value of money. That creates a differential that will be featuring in both the statement of financial position and the statement of comprehensive income. On the level of aggregation, obviously this, again, another cardinal principle of IFRS 17 not changing. And the measurement here is that the unlocking will require the continuation of the work that insurance companies have already started in terms of refinement of the assumption management in their actuarial models to ensure that the allocation of the relevant changes in cash flows is then calibrated to the various groups of contracts as defined by the standard. And finally, in terms of the optionality that this was sought after by several preparers, I know that a number of companies have told me that they were pleased that the IASB decided not to remove it and to leave it in place. That leaves still a very transparent set of disclosures that if you are an investor, you can access directly from the financial statements and recalculate with a sufficient level of easiness an alternative performance basis that doesn't actually have the benefit of the OCR solution.
So what is in the exposure draft? So basically there are 12 targeted amendments to the standard, which are in 8 different areas that we've set out on the slide. I'm going to go through the 12 targeted areas today, but in addition to these targeted amendments, the ED does also include a number of minor amendments, such as clarification about the definition of an investment component. So you should look at those as well. So the first amendment is to the effective date of IFRS 17 and for IFRS 9 for insurance companies. And so the exposure draft is proposing that all companies applying IFRS standards would be required to apply both IFRS 9 and IFRS 17 for their annual reporting periods from the 1st of January 2022. Now, we know that some would have liked us to propose a longer deferral than just 1 year, but we were trying to balance that desire, and also the fact that we know that because we are tinkering with the standard, we do need to allow for the uncertainty that provides, and we do need to be cognizant of that, which is why we did propose a deferral of the date. But on the other side, we really want IFRS 17 to be in place as soon as possible, because we think it's really an urgently needed improvement to address the current inadequacies in insurance accounting practices around the world, the lack of comparability. And also it reflects the fact that while some stakeholders expressed the view that the effective date of 17 should be deferred by 2 or 3 years to allow additional time for implementation, there were other stakeholders, especially those that were more advanced in their implementation, who really expressed concerns that deferring the effective date of IFRS 17 any longer than 1 year could in fact increase their costs of implementation, and they didn't want a longer deferral. On IFRS 9, the proposal to defer IFRS 9 wasn't just an automatic decision by the board, but we did decide that on balance, deferring by only 1 further year was probably appropriate in order to keep this alignment between 17 and 9 for insurance companies to enable them to apply both standards at the same time.
If you look at the practical implications, these are perhaps the ones that are the most far-reaching because they touch effectively the entire implementation program. And what we have put on this slide is just an example of how our implementation clients are organizing themselves at the moment with the new timetable. What we have effectively noticed is that the speed of work has not really slowed down as a result of the proposed, but everyone is now focusing more on the quality of the work that they're doing. And so what it is now anticipated is that the majority of the clients we've been working with will effectively continue the implementation very close to the end of 2020, and then use the effectively 2021 to conduct activities like parallel run. Mm-hmm. So the parallel run is effectively when you have already closed your last set of IFRS 4 numbers, if you like, prior to the restatement period to begin, the one in 2020. So you have effectively the opportunity to take those numbers and initiate the long process of restatement. But at that stage, there is no public information required, and so you can then operate privately to see how the numbers are going to look like, and then gradually build up as well to the level of audit quality necessary, given that the restatement will be subject to audit, the comparative figures. That makes the program able to support management not only to have greater confidence that the numbers prepared under IFRS 17 and 9 will be able to be accurate and subject to audit without problems, but also getting familiar with the new language, because chief executive, chief financial officers will have to be on stage as early as the spring of 2022 when they report Q1, if you have quarterly reporting, and explain the performance of the company using a very different language to the one used to date. And so that's in practice is probably what is most important in the parallel run. This also gives an advantage to the software vendors who have been very busy to understand all the requirements and trying to develop products that can actually help insurance companies capture the requirements in an efficient way. Particularly, one type of software has been very popular in the last 2 years. This is a software that is often referred to as the subledger, bringing together finance and actuarial data. Effectively, is a software that calculates the CSM and posts the CSM at a very granular level of detail in order then to interface the summary into a general ledger. And a number of these solutions were still testing how to analyze the requirements and to put them into the necessary level of software rigor. And these extra 12 months will certainly be used, it has been used already, in fact, to refine further the products that will help insurance companies to move forward.
Okay, moving on to the second area, there's two proposed amendments which are shown on this slide and the next one, which deal with the scope of IFRS 17. So which contracts you actually need to apply IFRS 17 to. So as you may know today, IFRS 17 applies to all insurance contracts with some specific exclusions, and the exposure draft is proposing to add another 2 further exclusions to reduce the IFRS 17 implementation for costs for companies that typically would not issue insurance contracts, for example, the banks. So the first proposed scope exclusion relates to some loans, and one example would be a loan where the requirement to repay the loan is waived at maturity if the borrower dies. So the exposure draft would propose that a company that issues a loan like that could choose to account for that loan on a portfolio basis, either applying IFRS 17 or IFRS 9. And the board decided that it was appropriate to allow a choice in this situation because both of those standards can provide useful information about those contracts. The second proposed scope exclusion is for some credit cards. So for example, those that provide coverage for the purchases made by a customer using a credit card. And this exclusion would apply if the pricing of the credit card does not reflect the customer's individual insurance risk. So in some cases, we know that banks issue these credit cards to provide insurance coverage because it's imposed on them by regulation, and there may be no charge for this insurance coverage. So in this case, the exposure draft proposes to require companies that issue such credit card contracts to apply IFRS 9 to these contracts rather than IFRS 17. Considering that the existing accounting for credit cards provides useful information, and we're not aware of any companies that today actually account for these credit cards as insurance contracts. And I think actually for me what's important about these scope exclusions is I think we may have lots of banks out there who didn't actually realise they should have been reading IFRS 17 already.
Yes, indeed. The change that, the practical implication that this change produce are neutral for insurance companies. So I believe that the effect analysis that Sue just summarized, the IASB has conducted on this change is absolutely spot on. Obviously, as a consumer, I regret that I will not be able to see what is the CSM on my credit card, but I think that with that humorous comment, I believe that this will be a very welcome change by all parties.
Okay, now moving on to the proposals which relate to measurement requirements in IFRS 17. So today, IFRS 17 requires an insurer to consider acquisition costs when they determine the expected profit on their insurance contracts. And the insurer is required to consider these costs by firstly recognising them as an asset until the contracts are recognised, or by including them in the cash flows expected to fulfil the insurance contracts once the contracts are recognised. Now, in some cases, we know that insurers pay non-refundable commissions for new insurance contracts where it expects policyholders to renew those contracts in the future. And sometimes those commissions can exceed the premiums for the initial contract because the insurer is expecting to recover the commission from those future renewals. So IFRS 17 as written today would require the full commission to be attributed to that initial contract, and that can cause some initial contracts to be loss-making, and people told us that was inconsistent with the economics of those situations. So the proposed amendment would result in part of the commissions in these cases being allocated to the expected future renewals. So any acquisition cost paid would be allocated to expected renewals, would be recognised as an asset until those future renewals are recognised. Now, so we may have an asset that's got a longer life and it's got more uncertainty attached to it than we've got under existing IFRS 17. So we've got impairment proposals as well. So if facts and circumstances indicate that the asset may be impaired, the insurer would be required to assess the recoverability of that acquisition cost asset each period before the renewed contracts are recognised, and be required to recognise a loss if the cost is not recoverable, for example, if you no longer expect the renewal to happen. Now, we've got a simple example of how this works to try and further illustrate what we mean. So in this simple example, we've got an insurer who pays a non-refundable commission of $150 for new contracts that it will issue in year one. So the policyholders of new contracts are expected to pay premiums of $100 in year one, with expected renewals in years 2 and 3, also with premiums of $100 expected for each of those subsequent years. And for simplicity's sake, we've just ignored any claim expectations. So looking at the red table on the left-hand side, applying IFRS 17 as originally issued, the full 150 commission would be included in the measurement of the year one contracts, and so there'd be an expected loss of 50 for those contracts compared to an expected profit of 100 for the future renewals that are expected in years 2 and 3. In comparison, if you look at the proposed amendments, it's illustrated in the table on the right-hand side of the slide. The insurer would allocate some of the commissions to the expected renewals in year 2 and 3. So in our very simple example here, we've assumed that 50 of the commission is allocated to years 1, 2 and 3. So we get an expected profit now in year 1 of 50, and in year 1, the 100 of commissions which are allocated to the expected renewals would stay on the balance sheet as an asset until those renewals are recognised, being tested for impairment along the way.
Now, this is a very important amendment to IFRS 17 from a practical perspective. The distribution arrangements that are present in the marketplace, they often give credit to the possibility that new customers have a high propensity to renew the first contract. And so distribution arrangements, particularly when markets are more competitive than others, would evolve in a way that the non-refundable upfront commission on the size illustrated in the example earlier would be fairly typical. This makes, in my opinion, a much more practical application of the principle that was already there of pre-coverage assets. But as Sue mentioned, clearly the asset is going to be a larger one, given the size of commissions that are payable in a number of cases. Overall, I think that people will look at this as a more comprehensive suite of requirements for pre-coverage assets. And although there is more work to be done, the allocation basis in particular will have to be developed. The disclosure around the expected runoff for the allocation of the pre-coverage assets, and the development of an impairment testing to be exercised when facts and circumstances call for it, are effectively new requirements that did not exist in IFRS 17 before the amendments. But the benefits the benefits that will come from this extra implementation work are certainly recognized by everyone we've been talking to as worth the investment.
Okay. And I think it's an example. I mentioned there were some cases where I think the amendments help insurance companies better explain their performance. I think this could be an example of that.
Yes.
Okay, so the next topic is about the recognition of the contractual service margin, or CSM, in profit or loss, which is determined by allocating the CSM balance to coverage units over the duration of insurance contracts. So applying the general model to insurance contracts without direct participation features, the quantity of benefits and the period over which those benefits are provided under IFRS 17 today relate only to insurance coverage, and they don't take account of any investment services that might be provided by the contracts. People brought to our attention the concern that there may be situations where people felt there were investment return services related to things that are not participating contracts, and also where there may be differences in the period of the insurance coverage and the period over which those services might be provided. So the proposed amendment would result in coverage units under the general model being determined by considering both insurance coverage and any investment return service, which is a new concept being proposed for the standard. The exposure draft includes proposed conditions for when an investment return service might be provided, and it also proposes that a company discloses the relative weighting of insurance coverage and investment return service that has been used when you're doing the CSM allocation. So the practical implication of the proposed amendment is illustrated with a very simple example on the next slide. So in this simplified example, we've got a company that's issuing a 10-year insurance contract under the general model. It provides insurance coverage for the first 6 years, excuse me, and it includes an investment component for 10 years. Applying IFRS 17 as was originally issued, the profit generated by the insurance contract is required to be recognised in full over the 6-year insurance coverage period, in line with the pattern of provision of insurance coverage. Applying the proposed amendment, if the company determines that an investment return service is being provided by the contract, the profits would instead be recognised over a period of 10 years, considering the pattern of provision both of insurance coverage and the investment return service.
Now, this is another very important change, proposed change in IFRS 17. It clearly introduces now a consistency in the emergence of profit in the wider population of what we call, in Deloitte at least, participating contracts. Direct participating contracts under the VFA, and the indirect participating contracts that although they are under the general measurement model, they have also some special requirements codified in IFRS 17. Although the difference remains between these two subsets in terms of the unlocking of the CSM, with the first group fully unlocking with both financial and non-financial variables, rather than the latter unlocking for financial variables only to the extent that the change in financial variables triggers a change in the discretion of the issuer. The emergence of profit now is on a level playing field. This means that, for example, markets that are like Hong Kong here in Asia, where they have effectively a very balanced split between indirect and direct participating contracts, can actually have the expectation of profit reporting from the different players in the market to be on a consistent basis, and this is clearly advantageous for the users. From an implementation perspective, this will call for a new focus on the coverage unit. It was already a big topic up until the publication of the disclosure draft, but now the disclosure draft has effectively given an even brighter green light to focus all energy that remain to be spent on the calculation of the CSM, on the development of the hybrid coverage units required for the combination of insurance coverage and the two possible types of investment-related services.
Okay, so the next proposed amendment relates to the risk mitigation option that's available under IFRS 17 for contracts that are accounted for applying the variable fee approach, so for contracts with direct participation features. So that option is already in IFRS 17 as originally issued in order to mitigate any accounting mismatches between variable fee contracts where the insurer is using derivatives to mitigate financial risk arising from those contracts. And some stakeholders brought to our attention the fact that a similar accounting mismatch might arise when an insurer purchases reinsurance for variable fee contracts to mitigate financial risk. And so the exposure draft proposes to basically extend the existing risk mitigation option so that it would be available for insurers to use where they use reinsurance to mitigate their financial risk on variable fee contracts.
The extension of the risk mitigation to reinsurance is a logical conclusion. And from a practical implication perspective, a number of the more sophisticated hedging programs that life insurance companies have adopted over the years do indeed combine derivatives and reinsurance to effectively protect the shareholder profit emerging from the participating funds from the impact that will be caused by the cost of guarantees that they have effectively given to the contracts the policyholders have purchased. So this again will clarify the existing activity of implementation in the new form of, as I call it, maybe spuriously hedge accounting from IFRS 17, and allow then the inclusion on the same stream of implementation work also the insurance contracts.
Okay, so next we have a second amendment relating to reinsurance. So IFRS 17 requires an insurer, as I'm sure you know, to recognise any losses on initial recognition of an insurance contract immediately in profit or loss. But on the reinsurance side, applying IFRS 17 as it is today, any net cost or net gain of purchasing a reinsurance contract is recognised in profit or loss over time as reinsurance services are received. And so this can result in an accounting mismatch because while the loss on the insurance contract is recognised immediately, any expected recovery of that loss from the reinsurance contract is recognised over time. So the proposed amendment addresses this accounting mismatch by requiring an insurer to recognise a gain on the reinsurance contract at the same time that it recognises losses on initial recognition of the underlying insurance contract. So for the proposed amendment to apply, there's a couple of conditions. The first is that the reinsurance contract is required to be entered into before or at the same time as the loss-making insurance contract. And secondly, the reinsurance contract must provide coverage for a fixed proportion of the claims. And the slide on the next page is again a simple example of how this would work. So in this case, we've got an insurer who issues insurance contracts with expected premiums of 100 and claims of 150, so resulting in a loss in profit or loss immediately of 50. So at the same time, the insurer has purchased reinsurance, which enables them to recover 80% of all the claims on the underlying insurance contracts, and they're paying a premium of 125. So the claims expected to be recovered are 120, being 80% of the underlying claims of 150, so the overall net cost of purchasing this reinsurance is 5. Looking at the red table on the left-hand side and looking at what IFRS 17 would require today, that would mean that the net cost of 5 is recognised over time as services are received from the reinsurer. Now, if I look at the right-hand side of this slide, this shows what would happen with the proposed amendment. So a recovery of 40 would be recognised at the same time as a loss of 50, reflecting the fact that the insurer expects to recover 80% of the claims on the insurance contracts. So as a very simple mechanism, which is partly why we focus on the proportionate contracts, we just treat 80% of the loss on the insurance contract as being recovered by the reinsurance contract. So the adjusted net cost of the reinsurance of 45 would be recognised over time as services are received from the reinsurer.
I would say that this probably is the third most important change. When we look back and the acquisition cost, changing the coverage units for participating contracts, the rectification of the accounting for cedent in the eventuality of an onerous onerous group of contracts at initial recognition is certainly something that I would personally welcome. From a practical perspective, this means now that the implementation work will focus on understanding when this credit from the insurance contracts can be secured at initial recognition, given the qualification the IASB has introduced with the amendments to restrict that credit to reinsurance contracts that have proportionate coverage on the ceded business. And we have already seen that even prior to the publication of the exposure draft, a lot of clients have been exercising themselves to establish whether or not the program they were actually in scope of these or not. Is also one that will call for changes in the implementation areas surrounding reinsurance programs. It's an area that has already caused a lot of effort being dedicated. Primarily because reinsurance is numerically a smaller population of contracts for the cedent's perspective, but they tend to have a much more important effect on the P&L. And therefore the effort of integrating the management of the assumptions from an actuarial perspective with the reinsurance models has called for a greater proportionate effort than you would have done actually for the direct business, given the number of contracts that you have as a cedent in your books.
Okay, so now changing tack a bit and moving on to presentation on the balance sheet. So today, IFRS 17 requires that groups of insurance contracts that are in an asset position are presented separately from groups of insurance contracts that are in a liability position. And whether or not a group of insurance contracts is in an asset or a liability position largely depends on the net cash flows, such as premiums to be received and claims to be paid for each group of insurance contracts. And what we've heard as people have been implementing IFRS 17 is that identifying the net cash flows for groups of insurance contracts really requires integration of systems that are quite independent today, such as cash management systems and actuarial systems, and requires this group concept to be meshed into cash management systems, which is quite a challenge. So the proposed amendment aims to provide practical relief for insurers by requiring them to present insurance contract assets and liabilities on the balance sheet separately, but now at a portfolio level rather than at a group level, so that there'd be no need to integrate independent systems at a level of a group of contracts solely to work out how to do presentation on the balance sheet.
Now, this removes the only visible requirement to present groups of contracts in the primary financial statements, unless they are onerous, in which case you see that through the P&L loss. There is obviously an advantage because of the possibility now to limit the upgrades of working capital systems, for example, the ones that are dedicated to the premium collection and claims disbursements, because those are going to be managed effectively to produce balances that are on a portfolio basis only. This is expected to limit the cost on those upgrades. But from our point of view at this stage, we have yet to see a true significant benefit coming across, and we will be working with our clients during the course of the summer to appreciate the full extent of the simplified presentation in the balance sheet, and capture effectively any benefits that is really possible in the working capital systems.
Okay, interesting. Okay, and last but not least, transition, always everybody's favourite. So the exposure draft is proposing to include in IFRS 17 3 additional reliefs that insurers could use when they apply IFRS 17 for the first time. And in addition to the 3 additional reliefs, we've made a comment on the basis for conclusions on the exposure draft too, that explains that we expect that companies will make estimates in determining IFRS 17 transition amounts, as you do on transition with every IFRS standards. And this seems like a bit of an unusual statement to make in the basis, so maybe to add a little bit of colour, We've heard quite a lot of concern from stakeholders about whether or not they're forced to move to fair value. And some of that seems to be because people are concerned that because we developed these very specific transition reliefs, particularly with the modified retrospective transition, that it might somehow imply that you have to have the perfect information unless it's something that's on the list. And we wanted to make the point that the normal processes that you would apply when you transition to any IFRS standard, whether you're applying the full retrospective approach or the modified retrospective approach, continue to apply. So, use your normal standard. We're not holding you to a higher level of accountability than when we usually would. So that's in the basis. But then moving on to the three changes to transition. So the first proposed new transition relief is about contracts that were acquired before the transition date that companies might not be able to distinguish from contracts that they issued themselves. And this distinction is required when you apply IFRS 17 because if you've got a liability for claim settlement, it's treated as a liability for remaining coverage if the contract was acquired in a business combination, whereas it's treated as a liability for incurred claims if the contract was issued by the company. And people have told us that they can't necessarily tell what the background was for these contracts once they're all put together in one system. So the proposed amendment would permit a company to account for liabilities for claims settlement acquired in a business combination before the transition date as a liability for incurred claims if the company cannot identify the claims liabilities that it's acquired.
The practical implications that come from this is that you have now for the segment of the industry that is going to making the premium allocation approach measurement as their primary measurement basis, really into some very substantial cost saving, potentially to remove completely, at least for a number of years, the need to develop a CSM calculation engine. Because if you think about this relief, it's effectively targeting liability for incurred claims that were acquired some time ago. And if you are a company that has not done recent acquisitions or not planning to do acquisitions in the near future, you may actually have the window where you can just implement PAA, take advantage of this relief, avoiding effectively the calculation of a CSM on the acquired liability for incurred claims, maybe taken over from a business 10 years ago, and prepare yourself with more time for the next acquisition, maybe coming in 5 years' time. At that point, then obviously the standard will apply. The need to turn the liability for incurred claims into a liability for remaining coverage will bite. Mm-hmm. But this clearly is an important relief, particularly applicable for the general insurance companies. We will also see how this impacts the transition net asset in terms of equity. Clearly, from the way I read this project draft, if you have that difference, it will go into retained earnings, and we'll see whether others will comment in that regard. And if that's confirmed, then there could be an interesting figure also for the analysts and the users to analyze and consider.
Okay, so we also have two more reliefs proposed to the transition requirements, both of which relate to this risk mitigation option for variable fee contracts that we were talking about earlier, that Francesco referred to as a sort of quasi-hedge accounting model. So some stakeholders have expressed concerns because IFRS 17 prohibits the retrospective application of the risk mitigation option. So in response to this concern, there are two amendments proposed in the exposure draft. So the first one that's shown on this slide would permit an insurer to apply the risk mitigation option prospectively from an earlier date. So at the moment, IFRS 17 says you can only apply the risk mitigation option prospectively from the date of initial application. What's in the exposure draft is the option to start applying it from the transition date, so a year earlier, the beginning of the comparative period. So basically what this would do would be to reduce the potential for mismatches during the comparative period. Yep. The second relief shown on this slide would permit an insurer to apply the fair value approach for a group of variable fee contracts that would otherwise be accounted for retrospectively if specified conditions are met. So you might remember that usually you can only apply the fair value approach on transition if you can't apply the standard retrospectively. What we'd be saying is that you can apply the risk mitigation option even if you could, in theory, account for the standard retrospectively if you're using risk mitigation activities and they were in place before the transition date. So, and that means that basically the effect of the risk mitigation activities in place before the transition date would be treated consistently in equity and transition. So for both the derivative and the reinsurance contract and the related insurance contract, they'd both be in opening retained earnings rather than one being in opening retained earnings and one being in the CSM.
Absolutely. And in fact, that is probably of the transition relief, the one that I would label as the most impactful one, given the size of these hedging programs that we have seen all over the world have been built over the years. The solution that the IASB has taken, in my opinion, is quite courageous. It takes a really measure to the restatement principle that otherwise would be creating that difference, and offer through the evaluation of both ends of the hedging relationship the elimination substantially of the accounting mismatch. The practicality here, first of all, there is the entire organization of the new accounting, effectively how to separate from the unlocking of the CSM the effects of the financial risk, do the same on the insurance side, so all the new things we already talked about. The other thing is that people are now studying whether this evaluation of both ends of the hedging relationship results in some loss of the retail profit in the variable fee approach liability, because you're effectively fair valuing the whole contract as effectively you cannot take a half measure, you have to take the whole thing, which means that a wholesale perspective will be adopted on a significant proportion of the liability where perhaps a price advantage would have been visible if you were doing the full restatement. So it's a big decision that these companies will have to study as to whether take full advantage of the elimination of the mismatch between the hedging programs and the liabilities that they are hedging versus the potential loss through equity of deferred profit that would otherwise be part of the CSM if the full restatement had been adopted. The interesting thing is that the answer to that question will be subject to the volatility of the financial markets, and only when you get closer to the end of next year you can start actually seeing what is going to be the 31st of December position of the various financial variables, interest rates, equity, stock prices, etc. They can really make a call as to whether or not the accumulated gain or loss on your derivative program can stay in equity alone, or whether you have to fair value the other leg and bring effectively the opposite to mitigate the impact on equity. So a lot of work that needs to be calibrated in implementation, but certainly a solution available to deal with a substantial accounting mismatch that was raised by a number of stakeholders in the past.
I might just mention one other thing while we're here, if that's okay, Francesco.
Yes.
And that's, I'm sure a lot of people listening to this and when they read the ED will think, why on earth don't you just let us apply this retrospectively? And the board did talk about that a lot, and there's quite a discussion about it in the exposure draft. And the short answer for why on earth does the board not just say that is because this is an option, and because you can apply it to individual contracts and individual risks within contracts. The board was very concerned that people could use hindsight and cherry pick what their profit would be, knowing which relationships to pick. So we had quite a long discussion at the board table about whether we could require the use of this retrospectively to all relationships to reduce the cherry picking risk, and concluded that we could never check completeness because there's been no historical documentation requirement. But if you're listening and you're planning to write to me to say, let's just make it retrospective, please tell me an answer to my cherry picking problem.
Certainly inspirational for those who are preparing their pens for the comment letters due on 25th of September.
Yes. Okay, which is a good point to move on to the next step. So we published the exposure draft on the 26th of June. If you haven't read it yet, you can download it from our website. It's open for comment until the 25th of September, so please do send in your letters. And in addition to the exposure draft, we've got a lot of different material on the website that I just wanted to quickly draw to your attention because it's quite a heavy read, despite our best efforts, and it's useful to have other materials to look at as well. So we've got the exposure draft itself, which sets out the proposed amendments, the basis for conclusion, which sets out the rationale not just for the proposed amendments, but for the things we decided not to address, as I mentioned up front. We've got a short snapshot document, which just gives a very high-level overview of the amendments and why we're proposing them. And also, it's not shown on the slide, but on the website, there's an additional resource which might be helpful for those of you who are real geeks and really love our standards. There's a version of IFRS 17 which shows the proposed amendments in the context of the entire standard, if you find that easier to read.
The last one was particularly important for the users. In fact, is the document that I've been using myself the most, and I would recommend not only if you're a geek, but also if you just want to see how the standard is going to look like if these proposals are adopted. That is probably the document I suggest you start. Now, we remain at Deloitte very focused in helping everyone make sense of what's going on in IFRS 17, and so the last slide before we open the floor for questions is just to remind you on how we can stay up to date using social media or our own website. So first of all, thank you very much, Sue. We have already received a number of questions, so I'm going to now read out in chronological order the questions that have come through, and then together we'll try to use the remaining 10 minutes of our slot to answer as many questions as possible.
You might want to cherry pick a bit.
Let's begin from this long question. So there is the submitting party says is a procedural question. The first one, in several parts actually. The first part is will the change in the text of the standard result in a new basis of conclusion and illustrative examples?
So when we finalise the discussions, we'll end up with additions of basis paragraphs to IFRS 17, and if we need new illustrative examples, yes. So ultimately there will be one new version of 17 with all the amendments and explanations. The question about the TRG materials is a good question. It also relates to our other educational materials. We're going to sort of review what we might need to withdraw, modify, ultimately once we've finalised the standard.
And for those on the phone that may not have access to the chat box, the second question was about the possibility for reassessing any of the TRG material that have been. Then the next question will be related to the text. Question that were answered based on extensive discussion and analysis. Since the answer in many cases refer to various parts of the standard, it is not always straightforward if a certain TRG answer remains valid or not. But as you explained, Sue, there will be something that was announced actually at the last TRG in April. The IASB will at one point tell us how the work done by myself and my other 13 colleagues on the TRG be captured for future use.
Yeah, exactly. There's a broader question there.
Yeah. Okay, let's move then to the next question.
But in terms of the references to paragraphs and things, we tend to change the standard in a way that we'll try and keep the old paragraph references, so they will still be valid anyway.
So that's why you've got a lot of paragraphs with the A and B
A's
and
and
C.
B's and C's. Yeah.
The next question is, can the insurance acquisition cash flows be deferred under all measurement models?
Short answer is yes.
Yeah.
But for the PAA, you could still just choose to expense it like you can today.
In fact, there was a question that was raised by me at the recent roundtable in Hong Kong last week. And it's unclear, and I will comment on that, propose to comment on that at least in the Deloitte letter, whether the choice is after you have done the allocation or before. So effectively, I got the impression that the pre-coverage assets may actually have to be there all the time, otherwise that loss-making situation that you were trying to avoid could effectively emerge as a result of a policy choice. And that would create inconsistency. Potentially.
I think the intention would be it's a one-off choice that survives all time, effectively, but you're right, it's probably not 100% clear.
Thank you. And the next question is a comment actually that this party submitting the statement is that they will expect this to be this change on acquisition cost to be a positive one, welcomed by many parties. The next question is asking about the rationale on the reinsurance measurement from a cedant perspective. Why does not apply to retroactive reinsurance? This effectively is a stop loss, which effectively prevents the ultimate cost to buy the cedant beyond a particular level. I think it's connected also to the fact that there may be elements of the qualification that have convinced the IASB to actually introduce it in the first place. I remember that you were already alluding during your presentation earlier that the example is there to actually show that when you have the direct relationship between the cash flows of the insurance contract and it changes, and the underlying cash flows from the ceded or insured business, then there is merit to produce that particular change. But when the relationship is non-proportionate, you have more difficulty. Yeah,
it becomes much more complicated. And also, just mechanically, it wouldn't be impossible, but just mechanically, if we had a situation where the reinsurance came in after the loss on the insurance contract, in theory, the loss on the insurance contract should have already been booked anyway, so the mechanics don't really work terribly well if the gain is sort of subsequent to the initial loss recognition.
We have time just for one final question, and that is, for short-term contract using PAA, is there a need now to perform any measurement at group level rather than portfolio, given that presentation will be at a portfolio level in the balance sheet? It would appear to me that the measurement is the measurement, and I know that when I read the standard, it's very carefully drafted. Yes. The change in the level of aggregation is only for the presentation in the statement of financial position. So nothing else in the standard changes. Absolutely. So the measurement for PAA or GMM remains anchored on group of insurance contracts.
Absolutely no change. It's only a presentation change.
Yeah. Okay, that will be the end of our webcast. So I thank you again, Sue, for your very informative presentation on the exposure draft. I hope that all the participants today have been able to appreciate the content of the exposure draft, courtesy of the Vice Chair of the International Accounting Standard Board. And for Sue Lloyd and Francesco Nagari from Deloitte is thank you very much for your participation today, and goodbye.